Welcome back to our Explainer series. So, in our previous session, we nailed down something absolutely crucial. We learned exactly how to identify which financial assets are actually in scope for CECL, including those tricky off-balance sheet exposures. We also locked in that vital day one recognition rule, the one that says we have to record an allowance as a contra asset the literal moment an in-scope asset hits the books. Okay, so now that we know how to spot these assets, what's next? Well, the obvious question is, how on earth do we actually calculate that allowance? That's exactly what we're diving into today. We're going to unpack the repeatable framework you need to calculate these credit losses with absolute confidence. Let's get right to it.
Here's our roadmap for this explainer. We're taking a zoom-in approach. We'll start big with the continuous framework and the 7 steps to CECL. Then we'll zoom way in on a massive pivot point, the power of pooling. And finally, we'll wrap up with individual assessments.
Okay, let's dive into part 1, the continuous framework, which is a repeating process.
To really grasp this framework, we kind of need a foundational mindset shift right out of the gate. We have got to stop thinking of CECL as this, one-and-done mathematical formula that you just frantically run at year-end. It's not that at all. Instead, it's a living, breathing, repeating process. It's a highly structured framework that you literally have to apply at every single reporting period. And here's the kicker. Whether a company is estimating this allowance for the very first time on day one, or they're updating it for the 10th quarter in a row, the exact same level of rigor applies. Think of it like a continuous muscle that your accounting department has to flex. You run the framework, you assess the assets, record the allowance, and then, next reporting period, you do the whole shebang all over again.
Moving right along to part 2, the 7 steps to CECL. This is our pipeline.
I want you to think of this framework kind of like a giant assembly line. It takes raw asset data and transforms it into a precise, reconciled balance sheet allowance. So, step 1 is identifying all those in-scope financial assets at amortized cost. We're talking trade receivables, notes, HTM securities, stuff like that. We actually covered this heavily in our last explainer, making sure absolutely nothing gets excluded without a solid basis. Then, step 2, segmenting those assets into pools based on similar credit risk characteristics. Step 3 is picking the most appropriate estimation method for each of those pools. Maybe it's an aging method or maybe a discounted cash flow method. Step 4, you develop historical loss rates from your company's own write-off data, ideally spanning a full economic cycle. Step 5 is adjusting for current conditions, comparing the environment from when your historical data was generated to what's happening right now. Step 6, we apply qualitative factors or Q factors along with forward-looking economic forecasts. And finally, step 7, you apply your adjusted rates, book the adjustment, and reconcile. It's a really logical, continuous flow. But for today, we are focusing our magnifying glass directly onto step 2.
Let's see how this builds as we move into part 3, the power of pooling and those shared credit risk characteristics.
Now, you might be wondering, why on earth are we dedicating so much time to just one single step? Well, because pooling is the critical domino. Seriously, the pool definition determines the quality of the entire model. I want you to really internalize the stakes here. Pooling is, hands down, the most judgment-intensive step in the whole CECL framework. Because assets in the same pool are estimated together using a single loss rate, if you group the wrong assets together, if you just get your pooling wrong at step 2, every single subsequent step is going to be fundamentally distorted. It's a chain reaction. Your historical rates will be skewed, your current condition adjustments won't make any sense, and your final balance sheet number, it's going to be completely indefensible.
So, how do we actually get it right? Well, assets need to be grouped based on shared credit risk characteristics, and specifically, you really want to focus on traits that genuinely affect the probability of loss. The interesting thing here is that the standard actually doesn't give you some rigid copy-paste checklist. Instead, it empowers companies to design their own pools, totally tailored to their specific portfolio. Generally speaking, we look at 3 main categories. First up, customer characteristics. This could be grouping by industry sector, the size of the customer, internal credit ratings, or even relationship history. Second, asset characteristics. For instance, are you separating trade receivables from notes? Are you splitting secured versus unsecured collateral? Or maybe you're grouping by payment terms, separating out the 30-day terms from the 90-day terms. And third, economic characteristics. This means grouping by geographic region, the currency involved, or maybe historical payment patterns. At the end of the day, the goal is simply to group assets together that behave similarly when it comes to credit risk.
And this brilliantly illustrates how this works in reality. Let's look at a pretty simple scenario. Imagine a company with customers scattered all across different industries and geographic regions. Instead of just getting lazy and throwing all their receivables into one giant bucket, they define 4 very specific pools. Pool 1 is domestic construction customers, which historically has a 5% loss rate. Pool 2 is domestic manufacturing customers, sitting at a much lower 2% historical loss rate. Pool 3 is domestic retail at a 3% loss rate. And then Pool 4 is their international customers, which happens to carry the highest risk at a 7% loss rate. Now, why does this matter? Because under CECL, each of these pools gets its own tailored treatment. So Pool 1 gets its 5% historical rate, sure, but it also gets its own specific current conditions assessment and its own unique Q factor adjustment based purely on what's happening in the domestic construction industry right now. You calculate the required allowance completely separately for each of these 4 pools, and then you just sum them all up at the very end.
So there is a really stark difference between an unacceptable approach and a fully CCL-compliant approach. An unacceptable approach is basically applying a single kind of lazy flat loss rate across a highly diverse portfolio. Think about it. If you've got international manufacturing clients completely mixed in with local retail clients, and you just decide to slap a flat 4% rate on absolutely everything, yeah, that is generally a huge no-go under CCL. It totally masks the true underlying risk. In contrast, the compliant approach segments those pools based on documented, shared risk differences. Honestly, the only time a single flat rate is ever acceptable is if your entire portfolio is genuinely 100% homogeneous with zero material differences in credit risk between your customers. And let's be real, that is incredibly rare. Above all else, your pooling approach must always be documented and completely defensible to an auditor.
Let's wrap up with Part 4. Individual assessments, which is essentially the exception to the rule.
All right, let's zoom back out from our pooling deep dive for a second to address the most obvious exception. What happens when you have an asset that is just entirely unique? Well, the rule is super clear on this. If an asset simply does not share credit risk characteristics with any defined pool, you literally cannot force it into one. It must be assessed individually. A classic example of this would be a massive one-off note receivable with some highly unusual or heavily negotiated terms. Basically, it's a unicorn sitting on your balance sheet. But I want to be crystal clear here, these unique assets do not magically escape CCL. No way. They still go through that exact same overarching 7-step framework. The only difference is simply that their expected loss estimate is going to be highly specific and individually calculated rather than being derived from a larger group rate.
So look at where we are. We now understand the continuous pipeline, we know how to properly segment those assets, and we know exactly how to handle those unique outliers. But that leaves us with the million-dollar question, doesn't it? Once your assets are perfectly pooled, how do we actually calculate the exact loss rate for each segment? Because, frankly, what happens if the mathematical method you choose to calculate that loss rate is just completely wrong? The standard definitely gives you choices, but picking the wrong one can be disastrous for your financials. Well, we are going to tackle the 6 permitted estimation methods in our next explainer. It's a big one. So until then, keep learning, and I'll see you next time.